think a number of foundations that maybe focus domestically struggle with a perception of risk in terms of grant making, taking the grant making overseas. Do you have any advice?
I think, as Oliver is sort of trying to actually get us as a foundation here to think about moving internationally, I think I would probably agree that yes, international philanthropy, international impact investment, is inherently riskier, not necessarily financially, but in terms of country stability and such like, and sometimes the rule of law. So I think one of the things to do is actually start to actually recognize and do really good risk analysis and acknowledge the real risks that exist. But then the flip side of that is the potential returns are also commensurately much greater. Quite often I would say that you're seeing something like an 8-to-1 to 10-to-1 ratio compared to very poor countries of what you can actually achieve in the same thing for the number of beneficiaries that you're going to see. So I would kind of like follow up from what Kat was actually saying and say, I think it's about sort of good change management. There's a number of different organizations that create and run vision trips, for instance. And they're great things for board members to go on. They're not necessarily putting money into those particular projects they go and see, but they start getting familiar with the issues. There is, the opportunity of going and looking at an area and the type of work that you're thinking of funding, and taking somebody with you so that they can be an advocate. There's the issue of quick wins. Find a couple of small, maybe a little bit riskier programs that is of a sort of small level in the foundation terms that people are willing to sort of sign off on and actually get some wins under your belt and then get the board members starting to actually be more familiar.
Oliver mentioned access to capital, healthcare. In your research, what have you found in terms of the universe of strategies either existing or emerging in those two areas?
Yeah, I mean, the one important caveat is if we're looking for a track record in impact investing, there's barely any track record. It's a very, very young space, Oliver. So it's hard to demand 10 years of track record, for instance. You might see 3 to 5 years. So that's the caveat. However, microfinance, with all of some of the recent issues with microfinance aside, has been extremely successful on the whole. It's also been financially successful. There, in particularly access to financial inclusion. So financial inclusion strategies like things around mobile money, ethical payday lending, all of these strategies actually have tremendous upside. That's actually kind of market rate upside as well as the social impact. But I guess I'd want to say, that there's another way to address this issue of wanting to go abroad and affect people abroad, and at the same time feeling that that's a risky strategy. Sometimes you can do both. If you think about where do the world's poor work, I mean, after agriculture, usually the next industry to move in is textiles. And so a lot of the world's poor work in textile mills. The problem in the textile industry right now is water, because textiles give off tremendous amounts of water, particularly from the dyeing process. So you could actually invest in a developed world fund that is looking at textile. I've seen funds like this that look at textile innovation for poverty, waterless dyeing, new synthetics, etc. Those are the kind of investments that are going to keep the textile industry strong and actually employ the world's poor. So sometimes you can do both if you dig into the kind of underlying issues